A continuation of the reopened IFB 2023 6.5 reopened bond. You have already watched this video that I've explained how you are going to save on the taxes that are charged on the money that you have put in your money market fund if you to transfer a portion of that amount to invest in this bond. You have also watched this video on how to create your CSD account using this Thou CSD application platform. You have also watched this video on how to do your bidding and how to pay for your bids. Today, I want us to look at the profitability. What is your expectation on this bond, and analyze that this is a medium-term bond. It's not a short-term bond, because short-term bonds are bonds or instruments that mature within a period of 1 year. Medium-term will be from 1 year to 3 years or 5 years. And long-term bonds or long-term investments will take a period of more than 5 years. We'll look at those details, those keen analyses, by analyzing the redemption structure of the reopened IFB bond after 3 seconds break. We begin by looking at certain facts or specific facts about this reopened bond. And number one is that this bond was originally issued in 2023 May, and it's supposed to have a maturity period, a horizon of 6.5 years, which means the original or the full term of this bond is 6.5 years, which takes us to year 2030. However, another fact number two is that infrastructure bonds they mature in phases. The government, which is the issuer or the borrower, does have a debt management structure in which it redeems infrastructure bonds in phases, depending on the amounts that have been invested. Another fact number three is that from the original bond prospectus on the issue of these bonds, that is the IFB 2023 6.5, is that any investment or all investments over a par value, nominal value of less than or up to 1 million, they are to be redeemed in full. That is 100% of the amounts invested will be refunded or repaid back to the investors in May of 2027. 4 is that reopening of a bond does not necessarily change the original terms of that bond. Therefore, that fact that the redemption of investments of up to 1 million is to be redeemed in full in 2027 May still stands. Further to that, investments that are over 1 million, 50% of those investments will be redeemed the same time, that is in May 2027. Another redemption of 30% and 20% on maturity of the remaining investments. That consequently means then that all investments, all investors who are going to put in this investment for this bond an amount of up to 1 million, they will have their investments redeemed by the government in May of 2027. Today being July, which effectively for this issue means May of 2024, then it means your investment of any amount within or up to 1 million will be over term. Your bond is of a maturity period of 3 years. And that makes it a medium-term investment. It is 3 years because if you count from May of 2024 to May of 2027, simple calculation, you just take the difference and that will give you 3 years because you are talking of a beginning of a period to end of a period. Now, bonds are fixed return instruments, which means that throughout the period, you will continue enjoying your return of 17.99%, which is equivalent of 18% per annum. Another fact is that bonds pay coupons 2 times in a year or biannually. That is, after every 6 months, a coupon is paid. The reason we are purchasing this bond in June or in August, because we are supposed to clear the paying for the bids by 16th of August, and I'm still referencing May, which is the issue date. The original issue date was in May of 2023, is that you will be required to pay the interest that has accrued between July last year, not July, but May this year, when the immediate coupon payment was done, up to the time you are paying for this bond, because that interest that has accrued shall be paid back when you are getting your coupon in November this year. That brings me to fact number 6, that specifically for this bond, IFB 2023 6.5 does pay its coupons in May and November each year. So the next coupon payment date shall be November of 2024. And for that reason, you are supposed to pay together with the amount that you are investing. And remember, the minimum investment in this bond and many bonds is 50,000 shillings. And if you are to increase that amount, it has to be in multiples of 50,000. Therefore, the amount, if you calculate, it will give you reasonably an amount of close to 4,000 shillings. And that means then the value or the accrued interest is in the neighborhood of 4.23. That makes the price, the actual price that you are going to pay for this bond to be 104.70 shillings for every 100 that you invest. That one aside, what is a redemption structure? A redemption structure is a tabulation of the redemption times and amounts in terms of percentages and the coupon payments of a bond. The coupon payments come in an amortization structure. But this one we have to look at, we are looking at a combination of the redemption of the capital invested and the payout of the coupons. We have already identified that if you are investing an amount that is up to or less than $1 million, your redemption date will be May of 2027, giving you an investment horizon of 3 years. But during that time, if we assume a person who has invested 100,000, but the amount that this person has bidded, the actual payment will include the accrued interest. So investing 100,000 would require the payment to be in the neighborhood of 104,000 thereabouts. So what will happen is that this person will receive the first coupon in November of 2024, this year, of about 9,000. Remember, our assumption is we are investing 100,000. So the first coupon of our 9,000 comes in November of 2024. There will be another coupon of 9,000 that will come in May 2025. A third coupon payment of 9,000 in November of 2025. Then the next one will be in May of 2026, followed by November 2026. Then a sixth one which will be paid together with the amount that you have invested in May 2027, because that will be the redemption date, which will be 100% of the amount that you have invested. Meaning that in May 2027, you will receive a combined amount of the coupon and the capital that will make it 109,000, which means in total, for the 3 years, this individual will have accumulated from this bond a total of 54,000 total of coupons, and the capital that gives us 154,000. An important thing to do is that the moment you receive these coupons, what makes a money market fund, those funds, look profitable, lucrative, is the element of compounding. And compounding is very important when you are doing your investments. How do you achieve compounding in this scenario? Because the settlement account that is connected to your CSD account with the central bank, that is where your money will automatically be wired on the coupon payment dates. So this investment will not have automatic reinvestment of your coupons to give you the benefit of compounding. So what are you supposed to do? The coupons, once they hit your settlement accounts, you are supposed to reinvest them again. But you will note that the minimum amount that you are required to have to invest in a treasury bill is 100,000, while that you are required to invest in a bond is 50,000. So those coupons do not meet the threshold or the minimum threshold for investment in the primary market. So what do you do in this case? You look for a high yielding saving account where you will park that money. If you have transferred your investment from a portion from your money market fund into this purchase of this bond, then you can reroute those coupon payments from your settlement account back to your money market fund accounts for 3 reasons. It will sit in the money market account as a way of accumulating. You want to accumulate or build up capital that you can use if it attains the minimum threshold that is required to invest, if you want to reinvest back in the treasury bills or in the bonds. Or rather, number 2, it could be a reason you want to build back your emergency fund because you reduce that amount to take advantage of the reissue of these bonds. So you are rebuilding you are rerouting these coupon payments to the money market fund to rebuild your emergency fund. Another reason could be give your portfolio liquidity. Holding your money in a money market fund or the coupons back in the money market fund improves the liquidity of your entire portfolio because unlike the bond market, the money market funds are more accessible and flexible compared to the bond purchase. Another thing that you need to consider, having looked at that, is that right now, the highest paying money market fund, which is Saiton Money Market Fund, has a return of 15.64% net of tax. This bond is giving you a fixed return of about 18%, which is 17.99%. That gives us a difference of around 2 point something percent. The about of 2 something point 3 something percent. That is a margin. Don't forget that the returns, the yields in the money market funds do fluctuate as compared to the yields in a bond market that are fixed. So the element you have to look, because of comparing a mango to a mango, we have to look at the rate, the yield in the money market fund net of tax, because the bond is issued or the yield is tax free. So comparing that, this bond gives you over 200 basis points in return compared to the money market funds. We have chosen the highest return in the money market as at to date. We have also looked at that this is a medium-term bond because effectively it gives the shortest redemption or maturity period is of 3 years from today. The last thing that we'll ask to look at is the hedge rule. The hedge rule. That you don't have to put all your eggs in one basket. A portfolio needs to be balanced. You should have a portion of your investment sitting in the fixed return markets and another percentage of your portfolio sitting with the fluctuating or the higher risk markets, that is equities compared with bonds. And that one is pegged on your age. Your age gives you the percentage of your portfolio that should be sitting in the bond market or the fixed return investments. The reason is that your age gives you a measure of the amount of risk that you can take. How easy can you restore yourself in the event you lose in investing, in the high risk market? But wealth can faster be grown in the equity markets as compared to the bond markets. And for that reason, a younger person should be investing more in the equity market compared to the bond market for purposes of growing their wealth. So how to determine what goes to your equity portfolios? You take 100 minus your age. That is the percentage of your portfolio that should be sitting in the high risk options. Thank you for watching that video. Engage in the comment section. You can share this information to another person. Also, if there is value, give us a thumbs up and don't forget to subscribe to this channel.